Hi, all. This is Craig Cook with Acre Mortgage, and welcome to my new video about bank statement loans, an alternative method for financing for self employed borrowers. I'm super excited to give this presentation. I hope you learned something from this. If you don't mind, hit the like button, maybe share this with somebody else that might find this to be educational. And you can also hit that bell notification to get notified about other mortgage related products or topics that we go over. All right, so let's get right into it. What is a bank statement loan? This loan is a loan designed for self employed individuals, and it allows a borrower to use deposits into a business or personal bank account as a source for that lender to determine qualifying income. So if you own a business and let's just say you're a carpenter and you deposit money into a business or personal account that's related to your employment, that is what they would use to determine your income versus other methods, which would have to maybe use documents like tax returns for traditional mortgages. So, why is this important? Self employed borrowers can have difficulty obtaining home loans, right? It provides another option for borrowers looking to purchase or refinance their home where they might not be able to qualify. Traditional mortgages require an extensive qualification process. And what that means is that typically they're going to be looking at your tax returns, right? And tax returns are not always the easiest to decipher. You could have multiple businesses, you could have a lot of moving parts. And typically, if your accountant is very good, your accountant is going to probably try to get you to be able to pay the least amount in taxes as possible, which in return, in the mortgage world, shows you less qualifying income to be able to use to purchase a home. So it a traditional loan is not as easy. Well, this loan, or traditionally, it you would look at a W-2 wage earner and say, that's an easier loan to qualify for than reviewing tax returns, personal returns, business returns, maybe multiple returns, multiple schedules. So, even if you do qualify, there's a lot of stuff that goes into determining your eligibility as a business owner. Um, and simply put, I feel like as a business owner, it you really, just because your tax returns are prepared a certain way, it really doesn't always tell the full story of whether you're able to pay a loan back or not, right? So in some cases, you would think that that might be an unfair, you know, advantage to somebody that's a wage earner versus somebody that's self-employed. So traditional loans, why this may not be an option for somebody that's self-employed, right? You may not have the documents needed, right? What happens if you need to file taxes, right, to support what you've made in income for a previous year? So let's just say, for example, I had a really good year in 2022. Well, right now it's March, and you're not required to have your taxes prepared by April 18th, I think it is this year. Not until April 18th, I should say. And then even after that, you can file an extension. Um, if your most recent tax year hasn't been filed, you might not be able to use the income to qualify for a traditional loan off of that tax year because you haven't filed those taxes, and you need those returns in order to support and document income. You would be looking at income that's relevant to almost a year and some odd months old at your most recent 2 years, 21 and 20. And maybe that 21 return isn't as good as what it might be as if you were able to file that 22 return in a timely fashion. So having the documents needed is important. And if you don't have those, it might affect your ability to get qualified for a loan. Another big issue is the income that you're using to qualify for a traditional loan might not be enough to support the purchase price that you're looking to pay, or that the loan amount that you're looking to borrow, right? So maybe your accountant did a really good job of showing your net earnings after deductions being a certain amount, and that amount is not what you expected. It might not be enough to cover what you're looking for in terms of buying power. That's another downside why traditional loans might affect you negatively. The qualifying process could be more intensive or more extensive than another type of loan that doesn't involve looking at tax returns or transcripts or profit and loss statements that have to be reviewed with traditional financings. More documents can lead to more mistakes, right? So you might have somebody that has qualified you or pre-approved you, and maybe they didn't look at all the documents that were needed in a sense to underwrite a loan or get you truly approved. And that's dangerous, right? You never want to be in a position where you think you're okay to buy a house and you're unable to buy a house. And these bank statement loans, right? These traditional loans, they require that you go through an automated underwriting system. And in the traditional world, if you don't go through that software system as a certain status, like, for example, an approved eligible status, you're going to have trouble getting financing. And self-employment is a risk factor that's calculated in that software system, which might prevent you from getting a home loan, right? So these are all things that could prevent you as somebody that's self-employed to do a traditional loan. So what are some of the basic qualifications? There's certainly a lot of qualifications with all loan types, including the bank statement loan, but I wanted to give you some basic ideas. Typically, a bank statement loan requires you to have a 660 plus credit score. There could be investors that offer loans lower than that credit score. You just want to check with your lender. In the most case, the average score that's needed in my world and at my bank and the investors I work with is 660 plus. Typically, you need 10% or more in down payment than of the purchase price. And usually even 10% is not enough. And that really depends on what you're comfortable with paying in rates and costs, number one. And number two, the occupancy type, right? If you're buying a primary residence, they're typically going to allow you higher percentage financing than maybe an investment property or a vacation home. For the most part, all the programs would allow for 80% financing in most cases for any occupancy type. The higher the score, the better the terms, right? So if you don't have a certain credit score, let's say you need a 720 credit score in order to get 90% financing on a primary residence, that allows you better terms, right? You're able to borrow more, and maybe your credit score is better. So being at the low end of the window, whatever loan you're doing in credit score qualification isn't exactly getting you the best terms. But if you have the higher credit score, you'll end up getting better terms. Maybe it's higher percentage financing. Maybe it's better costs and rates. Derogatory events can affect you, just like in traditional financing. Bankruptcy and foreclosure, there are typically requirements for every investor with regards to when you can obtain financing with a program after that derogatory event. In most cases, though, in my experience in looking at these types of products, since they don't follow traditional rules, you can have flexibility with a derogatory event, meaning you can usually, and that's not all the time, but usually qualify sooner than if you were to look at the timelines that you're able to get financing for traditional mortgages. So, like for example, conventional financing, you're limited to 7 years unless you meet an exception after a foreclosure is the earliest you could qualify for a conventional loan. Well, that's not the case with a non-qualified mortgage product, and that's where the bank statement loan program follows under. Some lenders will allow you to have only 2 years after that derogatory event. So there is some upside to some of these credit related guidelines regarding derogatory events, but in any case, you're still going to have to check with your lender and see if they offer a product after a derogatory event, and make sure that you meet those timeline guidelines. But the good thing is they allow it. For the borrower, you have to be 2 years self-employed, which means we're going to have to provide documentation to support self-employment for the last 2 years, whether it's articles of incorporation, whether it's a business license, whether it's an accountant letter indicating that they filed taxes, what type of business you file, etc. You're going to, for the most part, have to be at least 2 years self-employed in order to do a program like this. They also want to make sure that you have 25% or more ownership in the company. And that's important in all loans. I feel like for the most part, in order to determine that you're self-employed, they want to make sure that you own more than 25%. We talked about a little bit about how you would provide evidence, right, that somebody is self-employed for a certain period of time: business license, CPA letter, Secretary of State filing. That's another document that you could use in order to support your history. Certain types of businesses may be ineligible. I know that, I guess the legalization of marijuana, there might be some state flexibility, but on the federal level, there isn't. Some of these businesses are not going to be eligible for using this program. So you want to check with your lender to make sure that you meet all the requirements for the type of business that you own. And what's some of the documentation that you're going to need for this type of program? So they have requirements for 12 and 24-month bank statement programs. Typically, you'd rather do the 12-month program because it's less documentation. You can see that, if you have 8 pages to, well, let's just say 10 pages to a bank statement, and you got 12 months of bank statements, that's 120 pieces of paper, right? Whether you're electronically sending it or printing it out and bringing it to your loan officer. There are programs that do the 12 and 24 months, but that's something that you might have to check with your lender on what's required for that specific program. Personal or business account statements can be used. So just because, let's just say you're somebody that does business online selling products on Amazon, you might file a Schedule C. You might not have a business account. Maybe you have a personal account set up where all of your business deposits go into that account. You can use either personal or business accounts. There's typically a business narrative form that gets filled out that kind of gives the lender an idea of the type of business and what expenses that you might incur with that type of business, right? You're obviously going to have different expenses if you're a contractor versus if you own your own accounting practices, which might have very little expenses. Or if you're, you own your own software coding company, right? There's only a certain percentage of what your earnings are that would be expense related. And they're going to want to be able to do a background search to make sure that business is, searchable on the internet, and make sure that they can find you on the internet so that they can legitimize the business. So how does a lender determine the loan amount for this type of product? So the deposits are added up in the time frame that we need, whether it's 12 months or 24 months, right? We're going to average all of those deposits based on that program type, whether it's 12 or 24 months, and then multiply the average of those deposits by an expense ratio. And that's usually determined by the lender. And how do they come up with that expense ratio? Similar to what we talked about before with a business narrative, right? So if you're, a business that doesn't have many expenses, you might have a smaller expense ratio, which means those average of deposits, more of the money from those deposits will be able to be used for qualifying income. The debt to income ratio is usually set between 45 and 50%. In that range, that's the most that you're going to see banks allow you to use. And again, occupancy and property can affect the loan, right? So if you're looking to purchase an investment property, they may require that debt to income ratio is lower, or your loan amount, right? That's all going to be relative to what you're able to qualify for, percentage of the purchase price, right? So that we call that loan to value. So, you might only be able to do 25% down and borrow 75% of the purchase price if you're looking at purchasing an investment property. That would also affect the loan amount. But in essence, how you determine a loan amount is basically what do you qualify for, right? What's your maximum amount you're qualified for based on determining your qualified income, and what's the occupancy, right? What's the amount that you're required to put down. Now, I didn't put a bullet point about this, but a lot of these investors that offer programs like this, including the investors I work with, they require a minimum loan amount, right? Most of my investors won't do loans under $125,000, and that goes with any type of non-traditional loan product. So if you're looking at lower loan amounts below that amount, it's going to be probably difficult for most banks to do any of these types of loans for you. Reserve requirements are a big part of your eligibility. And what are reserves, right? How does this affect you? And reserves are funds that are shown after settlement costs and down payment, not used. So if you owe between down payment and settlement $20,000 to write a check for at settlement, that's the money that's used. You also will be required to show what we call reserves, which are additional funds shown after the funds are paid at settlement. So going back to that example, if you owe $20,000 at closing and your mortgage payment is $3,000 and you're required to have 3 months of reserves, that means that you have $20,000 owed at settlement. You have 3 months of that mortgage payment of $3,000 saved in addition to that $20,000. That would mean that you need $29,000 in total funds needed, right? So you're only using $20,000 of that $29,000, and you're showing the additional $9,000 left over in an account that's acceptable for reserve funds. So occupancy and credit score can affect the reserve amounts. So if you're looking to purchase an investment property, then you're going to be required to have a certain number of reserves. That number might be 6 months of reserves. How does a month of reserve equate to? I was giving you an example, but 1 month of reserves is 1 month of the subject property mortgage payment. So like in that first example, I was saying $3,000 is your mortgage payment. If you needed 3 months reserves, that would be $9,000. The amount of properties that you own can affect your reserves. So for an example, one of my investors that offers this bank statement program requires that if you own a property, you're required to have, or I guess I should say no matter what, you need 3 months reserves for any program that they offer. If you own additional properties, it's 2 months additional reserves for any property owned that has financing. So for example, let's say you own 3 properties. You know that you need 3 months, right? of reserves because that program requires 3 months of reserves right off the gate, right out the gate. And then if you have 3 properties, you need 2 months of those each individual 3 properties, which would be an additional 6 months of reserve. So in total, you would need 9 months of reserves, right? 9 months of equal to the mortgage payment, the subject property mortgage payment, in addition to what you would need at settlement um, for the down payment and settlement fees. So if you look at the bottom, I tried to put this together. Down payment and settlement fees plus your reserve funds equals the funds needed. If you don't have this amount, or your lender isn't discussing with this, please make sure you ask the question, because this is an important part of your eligibility. Additional review. What are some of the pitfalls you can run into with this type of loan? NSF funds are something that I frequently have seen that have caused trouble with these types of loans. That stands for non-sufficient funds, right? So if you're consistently showing negative balances in an account that we're using for this program, you can run into problems really quick because they're worried that there could be issues going on with your business, right? So if you have NSF funds, they would need to be explained. And sometimes it's not an issue if you don't have a lot of these types of problems or negative balances on your 12 months bank statements, but you definitely want to talk to your lender about how they treat NSF funds. Account transfers, right? You can't use account transfers to support the deposits that are being used to qualify you for income. So a lot of times these banks don't want to see multiple accounts involved with the bank statement program. So for example, if you have let's say 3 bank accounts where you're consistently having money deposited from those 2 bank accounts into another account, they don't want to get involved with having multiple accounts. And that's the next thing that you're saying that could be an issue, and try to trace those deposits. So if you have multiple accounts where your business has multiple bank accounts or multiple transfers from different accounts, you can run into an issue with this. Multiple businesses, a lot of times, you may think that having I run a barber shop, or I do e-commerce, run an e-commerce business, I do this, and you want to kind of lump these businesses together to qualify. I found that that's difficult to do with most of these investors. Not saying it's impossible, but they kind of want to keep it as concise as possible. One account to be used for qualifying income, one particular business. Declining deposit trends. If they see that your deposits are declining from, let's just say, June to December, it might be simply because that's the way your business operates. Maybe because during the warmer months you're getting most of your business deposits, and during the colder months in the fall and in the winter you're not doing as much business, like if you ran an ice cream shop. But if it doesn't make sense and it doesn't add up, they're definitely going to look at your declining deposits. And even if you're averaging enough income to support the loan that you want, declining deposits could present itself to be an issue. What are some of the advantages to doing a bank statement loan? Well, traditional loans have loan limits that are typically lower. I know that some of these investors offer north of $2 million for their loan amount. So even in a situation where you're a business owner and you're looking at trying to get competitive interest rates using traditional financing, you may not be able to get that traditional loan because they're limited on what you can borrow, right? Fannie Mae and Freddie Mac, I believe, don't quote me if I'm wrong, but I believe it's $729,000 now, or maybe $729 and change, the loan limit. And if you're able to borrow millions of dollars at this point, that's a lot more of an advantage for you doing a loan like this as a business owner. More buying power, right? Traditional income calculations use tax returns, which could possibly lower the amount that you qualify for, right? We talked that in the previous, a couple slides ago, that if your job as an accountant is to reduce the amount of taxable income or show as little income, taxable income for your client, that's not helping you in terms of traditional financing and qualifying for more money. So you don't have to worry about only able to borrow a small amount of money. This loan might be your reason why you're able to borrow a lot more than a traditional loan. And simply put, another advantage is that you don't have to go through as much of the paperwork and the extensive calculations that are required for self-employment for traditional financing. What are some of the disadvantages to these types of loans? Because we all have advantages and disadvantages. These loans typically have higher rates than traditional financing. There's also higher costs involved. And, in my opinion, and this isn't always the case, but if you're making an offer in a seller's market, your offer strength plays a big role on whether you're, in line to be looked at or reviewed as a potential candidate to buy that property. And I feel like this could play a role in your offer strength. And sellers or agents that represent sellers may look at this loan as a riskier loan product for their client to be able to accept this over a traditional loan. So you might want to look out for that. So how do you get qualified for one of these types of loans? And it's simple. It's just the same as any other loan process. We have skilled individuals here at our office that are able to help you right away to start the application, obtain the necessary documents, go over the terms, and review those documents and get pre-approved and start looking at houses. This is how you contact us. There's my email. You can call us at that number. You can visit us. We're over here in Voorhees, New Jersey. And you can also connect with us online at acreloans.com, where we have information about products and other loans that we offer. And I hope you enjoyed this video. I look forward to talking to you again soon on the next one.